Hi everyone. In this video, we're going to wrap up our series here of the Chapter 6 workbook exercises. And here in this last video, we're going to complete AP 14B. This one's pretty quick, so I don't think it'll take us too long. First thing I'm going to do, though, just because I've had issues and I want to link these, is change all the formatting of these cells to the accounting format. So bear with me for one moment. I think that should do it. Okay, so when we're talking about classified balance sheet as we are in this problem, remember it's still the same thing as the balance sheet. We're still going to have assets, liabilities, and equity, but we're going to further divide all of these things into current and non-current categories, essentially. So for assets, everything that's going to go into current is going to be, we have cash, we have accounts receivable, and we have prepaid insurance. Non-current assets, and really they're kind of maybe easy to identify because they've specifically highlighted them as just property, plant, and equipment. That's the only non-current asset we have. And then remember our contra account for that. So then we can just link all the totals. So nothing really new in terms of what we're doing and in terms of understanding the balance sheet, and how it's laid out or anything. It's just, let's put a summation here. It's just really breaking it out into components so we can see, okay, these are all of our current assets. Put a little underline there. And these are all of our longer term assets, equipment that we're going to be depreciating. If we had other things like, a building or automobiles for the business, etc., those would all also be listed here, but we just have the one account for equipment. Our contra asset reduces the total, and we can see the net book value of our long-term total property, plant, and equipment is $21,900. Okay, and then similarly, on the liability side, we're going to have accounts payable, unearned revenue, and notes payable. I'll just link in the totals. Put a little underline there, auto sum. So now our total current liabilities, oh, you know what? I added too far down here. We really just want to have our long-term contain, now maybe we should, let me back up here, and we'll have to analyze the notes payable kind of separately. So remember, when we're talking about notes payable, so I'm not going to link it because I need to specifically identify, there's a current portion, and then there's notes payable, we'll say non-current portion. And so everything is included in one balance in the accounting records, unless you could theoretically set up a separate account that was current, non-current, but here, and it's kind of typical to see just one account for notes payable, but we need to get some information here. So it tells us that the notes payable is payable over 3 years. $6,000 is going to be paid within the next 12 months. So out of this $18,000, that tells us that since $6,000 of it will be paid in the next 12 months, that the current portion is $6,000. And then the non-current portion then is basically just everything else. So we can take the total minus the current portion. I spelled that wrong. Let me fix that real quick. And so then we break out this 18,000 between current and non-current down here. And you need this information. So if you have a problem like this on a test or a quiz or something, you will need to be provided additional information to understand what is the current, non-current portions. Okay, so then we just add those together to get total liabilities. We have capital here, and we should just be able to add these together. And you can see assets equal liabilities plus equity. So we're looking good there. And then the last part of this problem is just we're going to do some calculations and some analysis. Now we have the current, non-current portions broken out, and there's a few key metrics, ratios and other items. This first one's just a certain figure, not necessarily a ratio, but it is going to tell us how much working capital we have. And so to figure that out, we take our current assets, subtract our current liabilities, and that gives us working capital of $9,900. So one way to think about that is if we were to have these current assets be liquidated less the amount of current liabilities that we have, we would have additional capital of $9,900. So it's just a certain something to look at to gauge liquidity. In other words, to gauge whether it's potentially going to be an issue paying our current liabilities. As long as we have some positive working capital, that's a good indication that we will have the liquidity to pay those upcoming liabilities. If you see negative working capital, that could be a red flag, because that would indicate that we don't have liquid assets. Maybe we have a lot of long-term assets, but we don't have liquid, more current assets to pay off these current liabilities, which are going to be coming due, hence as they are current, essentially. So that's what that kind of tells us. And then here's another couple of ratios which are in the similar vein. So we can take total current assets and divide them by total current liabilities. So if we do assets divided by liabilities, that gives us 1.66. And anything above 1 is going to indicate that we have more assets, more current assets than current liabilities. And like I said, that's a place you want to be. If you have less than 1 here, that would indicate that you have got more liabilities than you have assets. And that could be a red flag for having enough cash and liquid assets to be able to pay upcoming current liabilities. And then there's another ratio that we're going to look at here, the last one, called the quick ratio, which doesn't take current assets, but takes the quick assets, which is basically in our instance here just cash and AR. Also short-term investments could fall into this category. But this excludes prepaid insurance, which really it kind of makes sense because prepaid insurance is not really something that's going to be accessible necessarily to pay off current liabilities. So what we're saying here is cash and AR are the most liquid assets in our balance sheet. We still use current liabilities. We don't do any changes there. And then we do that same division like we did for the current ratio. And so you can see it's a little bit lower because we took out prepaid insurance essentially from this calculation, but it still tells us we're above 1. One, if it came out to 1, it would mean that the numerator and denominator are the same, or in other words, your assets and liabilities in these ratios would be exactly the same. But because we're above 1, it indicates that our quick assets in this instance exceed our current liabilities, and that's generally where you want to be in terms of liability and having access to cash to pay upcoming amounts due, or in other words, current liabilities. So these metrics look pretty good, and that's just something, if you were actually in a business monitoring these on a recurring basis, you might want to benchmark this against your peers to see, how do we compare to other businesses in our industry, for example, if that information is available. And then you also would probably want to track this over time so that you could see if there's any fluctuations. If you're trending downwards, maybe that's a red flag or an indication that some liquidity is decreasing. And maybe that's okay. Maybe it's just part of the operations with what's going on at the business. But it might indicate that maybe you need to open a line of credit to be able to access cash through some sort of debt financing instrument like that. Something like that. So, it's, there's a whole world of possibilities about running a business, but having these kind of metrics do help us connect the bookkeeping type work we do with debits and credits and ensuring that the accounts are accurate, et cetera, and the financial statements are accurate with decision making about operations and the future of the business and planning and so on and so forth. So I like how we kind of move towards this calculation analysis perspective because it ties together more of a managerial perspective and not just a sole debits and credits technical backwards looking perspective. But not to discount that at all. It's extremely important that those processes and backwards looking historical bookkeeping and record keeping is extremely important, because if you don't have good records, then all of your planning could basically be for naught, because if you're not making, if your records are that you're planning, if you're using inaccurate records to try and plan and do all that, you're gonna run into issues essentially. So all the parts are really important, but hopefully this kind of gives you a little perspective into how what we're doing from an accounting perspective in solely, debits and credits can be converted into business decisions. All right, so that brings us to the end of our Chapter 6 workbook exercises. Hopefully you all found this helpful. And as always, reach out if you have any residual questions, and I will talk to you all soon. All right, thanks everybody. Bye.